The S&P 500 just hit the 100th percentile, and the S&P at this level has historically marked a regime inflection. Something is breaking beneath the surface, and the data confirms it. Right now, the S&P 500 is at 7,023, the 100th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection, says the data needs to confirm. The commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. Score 1 for the commodity analyst. Commodity supercycle. Oil agrees at $89.2. 116-day streak. Score 1 for Gammon. Credit will blow out. Investment grade spread agrees at 81 basis points. 3 days running. The volatility experts' volatility expansion call is paying off. VIX at 18.4 and trending their direction. 3 days running, McElroy is waiting on confirmation. The narrative holds, but the data has not validated it yet. 115-day streak, Hartman might be right, but the data has not confirmed the thesis yet. 109-day streak, the dollar analyst might be right, but the data has not confirmed the thesis yet. 5 days running, Snyder just moved from right to wrong. Bad stretch for Snyder, for now. Yield curve at 0.53% says the opposite of dollar liquidity crisis. Score today, 3 right, 3 early, 1 wrong. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. Today's big question, are commodities in a supercycle, or is this the top? On one side says the data needs to confirm. That is the setup. Everyone hears it on the podcasts. It sounds convincing. On the other side, the commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. Two smart people, opposite conclusions. So who is right? Here's what makes this interesting. Oil is falling while gold is rising. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. Oil at $89.2, 90th percentile, down 2.3% today. Gold at $4,830, 84th percentile, up 0.6% today. Copper at $6.08, 99th percentile, up 0.1% today. Bottom line, right now the commodity analyst has the better case. Copper at $6.08, 99th percentile, says the data is moving their direction. If oil drops below $80, the supercycle call is in trouble. Right now, it is at $89.2. If copper breaks to new highs while oil falls, it is demand rotation, not a supercycle. Oil at $89.2 is in the 90th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,830 will track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. High-yield spread just dropped 3.7% to 284 basis points. A move this size demands attention. Historically, high-yield stress at this level signals institutional risk aversion building. None of the 7 are talking about this. Keep it on your radar. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 69 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment-grade spread crossing 150 basis points. Currently at 81 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has yield curve, initial jobless claims flashing red. Gammon says, the Fed is breaking things and credit spreads will blow out. The data agrees with that assessment. Phase 1 holds with 69 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. Jefferson, AL, people moving in can't afford to live here. 22,742 households moved into Jefferson, AL. Their average income about $67,000. Median home, about $878,000. Unsustainable migration pattern, demand without purchasing power. Demand without purchasing power. WI, days on market is spiking in Wisconsin Rapids. Days on market in Wisconsin Rapids moved plus 100% in 30 days, now 192 days. Buyer leverage score, 62-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. VA, days on market is collapsing in Virginia Beach. Days on market in Virginia Beach moved 100% in 30 days, now 8 days. Buyer leverage score, 47-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, are commodities in a supercycle, or is this the top? Let me show you what happened the last time we were here. Copper at $6.08 is in the 99th percentile. That means it is higher than 99 out of 100 days in the past year. In 2022, copper dropped 35% on China lockdowns and global recession fears. In 2020, copper crashed in March, then doubled over the next year on stimulus demand. In 2011, copper peaked above 4.60, then gave back 30% as China growth slowed. Different environments, different catalysts. But every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, oil at $89.2 is in the 90th percentile. The last time both copper and oil were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. If history rhymes, the commodity analyst is on the right side of this trade. The data is not ambiguous. Here is what the data says to do right now. Stay alert on VIX. It is dropping 4% today. Fast moves demand attention. Avoid Denver at 36% payment burden. That is stretched territory. Watch high yield spread. It dropped 3.7% and nobody is talking about it. Every signal is live at analyze.builderslens.com. The podcasters give you the thesis. We give you the scoreboard. Subscribe and I will see you tomorrow morning.